If you think Wall Street only chases $300 megacaps and flashy AI names, today is your reality check. Some of the biggest money managers are quietly stacking shares of boring-looking low-teen stocks because when a stock is priced like the market has given up on it, even small improvements can create a big 2026 payoff. And as we head into 2026, strategists are broadly expecting another up year for equities, but with volatility and valuation risk still in the background, which is exactly when institutions often rotate into misunderstood value and cash flow stories. Quick note before we jump in. This is educational, not financial advice. Share prices are accurate as of Friday, December 26, 2025. Now, the common thread across all three picks is simple. They're trading around that $14 issue zone. They're heavily owned and actively traded by institutions, and each one has a clear, measurable set of catalysts that could matter a lot more in 2026 than the market is currently pricing in. First up, Ford, at about $13.30 a share today. Ford sits right in the sweet spot of too cheap to ignore, too big to be a meme. And the reason Wall Street keeps it on the board is that Ford isn't one business. It's multiple profit engines under one ticker. You've got the traditional vehicle business. You've got financing through Ford Credit. And you've got the commercial side that can be steadier and higher margin when managed well. On the big money's involved question, just look at who owns it. Major institutions like Vanguard and BlackRock are among the top holders, with Vanguard reporting, roughly, noticed approximately 11.95% ownership, and BlackRock also a major holder in recent filings. Institutions don't need a stock to be perfect. They need it to be mispriced. And with Ford, the mispricing often comes from investors fixating on EV losses while ignoring that the rest of the company can still throw off real earnings power. Here's what makes Ford a 2026 setup instead of a 2025 headline. In its Q3 2025 results, Ford laid out a full-year outlook around $6.5 billion adjusted EBIT and $2.3 billion adjusted free cash flow, while also highlighting how disruptions like the Novice aluminum supply issues were a major drag on guidance. Translation: if you believe 2025 contained unusual hits, 2026 has room for normalization. Reuters also reported Ford reaffirming that 2025 EBIT guidance even after additional supplier issues, while noting expected recovery dynamics into the next year. The bull case isn't everything goes right, it's less goes wrong, plus steady execution, improve cost structure, manage inventory, keep the profitable trucks and commercial business humming, and shrink the gap between the EV narrative and the actual consolidated cash picture. The bear case is also real. Autos are cyclical, competition is intense, and policy tariff shocks can swing margins. But that's exactly why the stock can hang out in the low teens risk is priced in. Institutions buy when they think the market is pricing in too much risk for the long-term earning power. Second, American Airlines, AAL. Today it trades around $15.40, close enough to our $14 theme that it fits the same category. Low priced, high sensitivity, high upside if the operating story keeps improving. Airlines are the kind of business where the market assumes disaster by default: fuel spikes, recession scares, labor costs, debt. So when the data points start bending the right direction, big funds notice, because the rebound math can be powerful. In Q3 2025, American reported record third-quarter revenue of about $13.7 billion. And the company talked through its results and outlook in its official release. Reuters also reported that American raised its 2025 profit forecasts, citing stronger premium demand and pricing gains tied to capacity discipline. That's a key 2026 angle. If the industry stays rational on capacity and consumers keep paying up for premium and loyalty-driven travel, the earnings quality can look very different than the market's airlines always burn cash stereotype. Now to the Wall Street is buying part. What's the evidence? One clean way to see institutional interest is ownership, data, and filings. Market beat lists, AALs, institutional ownership in the ballpark of approximately 52% and highlights ongoing 1-3F activity. And you can find specific examples of big managers adding shares, like the report that Federated Hermes increased its stake by 47.7%, buying 714,591 shares in the period referenced. No single fund move proves anything, but clusters of these moves tell you something important. Institutions are willing to underwrite the risks because the upside scenario steady demand. Better pricing, continued debt reduction can re-rate the stock. On debt and liquidity. Reporting around American's Q3 results pointed to ongoing deleveraging and liquidity levels, which matters because debt is the anchor that keeps airline valuations low. The risk section is straightforward. A sharp slowdown, a fuel shock, operational issues, or price wars can hit airlines fast. But that's also why the stock can be priced like a permanent problem. The 2026 bet is that the problem is cyclical, not permanent. Then that American continues tightening operations while demand holds. Third, OptimizeRx, OPRX, the least famous name of the three, and sometimes that's the point. It trades around $12.61 today, and it's one of those under-the-door healthcare tech plays that institutions like because the market often misprices small. Boring B2B even when the numbers are moving. If you want the purist, Wall Street is buying data point in this video. This one might be it. MarketBeat lists institutional ownership around approximately 76%, along with net institutional inflows over the last 12 months that outweigh outflows in their tracking. That's not retail hype, that's professional money taking meaningful positions. What's the 2026 catalyst? Unlike a lot of cheap stocks that survive on hope, OptimizeRx put real guideposts on the table. In its Q3 2025 release, the company raised 2025 guidance and also introduced 2026 guidance, projecting 2026 revenue of $118 million, $124 million, and adjusted EBITDA of $19 million, $22 million. That's huge for how institutions think. Guidance creates a measurable scoreboard. If management hits those range, or even shows they're trending, that way valuation can change quickly because investors start treating it less like a speculative small cap and more like a scaling platform with improving profitability. And the Q3 release also highlighted year-over-year growth in revenue and gross profit trends that support the operating leverage story. The risks. Also clear. Smaller companies can be volatile, customer concentration can matter, and healthcare pharma-adjacent budgets can tighten in downturns. Plus, insider selling headlines can spook markets even when the underlying business is fine. But when institutions hold a big chunk of the float, the upside can be sharper if the thesis starts working, because there simply aren't that many shares available when demand increases. So why would Wall Street buy all three at once? Because together they map to a classic 2026 institutional playbook. One beaten down, industrial cash flow. Story forward, one cyclical rebound candidate with improving fundamentals and pricing dynamics. American. And one under there are growth with earnings levers name that can re-rate on execution optimizes. And if 2026 is indeed up but choppy, that mix gives funds multiple ways to win without needing a single macro bet to be perfect. Also remember, institutions don't need every stock to be a 10-bagger. They need repeatable, exits, rising, liquidity, catalysts, and a timeline. These are liquid enough to size, cheap enough to matter, and catalyst-driven enough to monitor quarter by quarter. Here's how to think about them like a pro without pretending you can predict the future. With Ford, watch free cash flow, pricing power in trucks, commercial, and any evidence that 2025's disruptions really were temporary. With American White, watch unit revenue trends, capacity discipline, and the pace of debt reduction because deleveraging is what changes the long-term valuation story. And with OptimizeRx, watch whether that 2026 revenue EBITDA guidance is tracking, because hitting guidance is what brings in the next wave of institutional buyers, not just the first wave. If you made it this far, here's the closing takeaway. $14 stocks aren't automatically bargains, but misunderstood. Businesses priced in the low teens can become the exact kind of asymmetrical setups Wall Street loves. Not because they're cheap, but because expectations are low, catalysts are visible. And the big money is already positioning for a different 2026 narrative than the crowd is talking about today.